The stock market sold off again on Tuesday, with the Dow and S&P both closing well below the lowest level in over a month. So if the economy is so strong and inflation is going down, then why does the stock market continue to sell off? Well, it has to do with the news that came out today and the market's reaction to that news. There were two main headlines that came out today. The first showed that while the economy is strong for now, it might not continue to be strong in the future. And with the stock market being forward looking, the stock market sold off over fears of what the future US economy might look like over the next 6 months to a year. The second reason that the stock market sold off today had to do with the banks. You might remember the banking crisis that we had back in March with the bank collapses, the largest since 2008. Well, there are fears that that banking crisis is not over. And there's a lot of reasons to believe that. And we're going to talk about what some of those reasons are, especially the new reasons that were just introduced today. The stock market started its sell-off early in the pre-market hours after China surprised the world with rate cuts as their economy continues to grapple with a confidence crisis. This was the second rate cut in 3 months, and the move came just before China posted largely disappointing July data. Industrial output rose by 3.7% in July from a year ago, well below the 4.4% increase that analysts had expected, while retail sales also rose at a slower pace by 2.5% last month. And the rate cut in the morning wasn't the only rate cut they did. Late in the afternoon, the People's Bank of China cut short-term rates as well. The latest economic data coming out of China comes on top of a skew of weak economic numbers over the past week, including sluggish trade and consumer price numbers and record low credit growth. China is grappling with an ongoing slump in its massive real estate sector that has taken a toll on its economy. But really, who cares about China? Why would the news coming out of China affect the US stock market? Well, quite simply, it's because China is one of the largest economies in the world. And in the past, both in 1987 as well as 2008, when there have been major downturns in the US economy, those major downturns actually started in Asia. And then they moved to Europe and then eventually here to the United States. And with this major downturn in China's economy, there's a lot of fear that this could eventually cause a big downturn here in the United States. One of the reasons for that is if China's economy is slowing down so much, especially with exports, that means that consumers here in the United States aren't buying as many goods, and that in turn means that consumer spending might be going down, which could hurt US companies, which in turn hurts US stocks. Further, any downturn in Asia's economy is going to hurt its largest trade partner, which is the European Union. And that means the European Union countries are going to start going into a recession. And in fact, some already have. That in turn will eventually put the United States into a recession. So this is all bringing up fears that while the US economy is strong for now, and while inflation has been going down, and while the labor market remains strong for now, that things might turn around. One of those fears came last week when we saw inflation rise for the first time in over a year. We've also seen the labor market start to have a significant slowdown in the number of new jobs added. And the household jobs data is showing that the number of people who have jobs is actually going down as more and more people are getting laid off. So the economic news combined with the leading indicators all show that the US is going to head into a recession. Now, timing that is impossible. I remember earlier people were saying the end of 2022, then they were saying early 2023, then they were saying late 2023, and now they're saying early 2024. There's no doubt we're going to get a recession, but trying to figure out when is next to impossible. But with the stock market being forward looking, this stock market is going to start pricing in that recession at some point. And keep in mind, we usually don't bottom out until about 6 months before the recession comes to an end. So we definitely have more pain ahead. The question is, when does that pain actually start? And the bigger question is this pullback that we're getting here in August just part of the normal seasonality of the stock market, where the stock market would normally go down in August and September and have a little bit of a pullback before we bottom out and continue our rally in October? That's what historically happens. Or is this part of something bigger where we're going to get another 2022 type crash? We don't really know yet. We don't have enough data to make that determination at this time. But with the stock market historically going down in August and September, I personally feel like it's safe to go ahead and open up a few hedges in my portfolio. Now, I'm still buying stocks because the stock market does historically bottom out in October. So I'm still buying stocks, but I definitely have a hedge in case we get a bigger downturn. I have a QQQ put option as well as a VIX call option. Both of those will go up if the stock market goes down. And these are designed to hedge my portfolio against a bigger downturn in the market. So while I don't necessarily feel like it's a good idea to just go out and short the market yet, I do feel like it's a good idea to go ahead and open up some hedges. Now, you may have heard the news that Michael Burry bought $1.6 billion worth of put options on QQQ and SPY, basically shorting the S&P and the NASDAQ. I do want to clarify one thing on that, is that when put options or call options in general are reported on a 13F form, they are reported at their notional value, which is 100 times the actual cost. So yeah, he may have $1.6 billion worth of exposure to the NASDAQ and S&P short, but his cost was only probably closer to around $16 million, not $1.6 billion. So I just wanted to throw that out there for you guys so you know it's not nearly as big of a short as it appears to be, but it's definitely a pretty large short position. Now, let's talk about some other things that are happening right now, because the home builder market took a huge downturn. The stock market accelerated its sell-off about an hour before the market opened as home builder sentiment dropped sharply as mortgage rates surged over 7%. Rising mortgage rates are hitting potential homebuyers hard, and that is taking steam out of the home building market. Builder sentiment in the market for newly built homes dropped 6 points to 50 in August. That is the first decline in 7 months and the lowest level since May. To make matters worse, the share of builders cutting prices rose to 25% in August from 22% in July. And as home builders cut prices, this is just all part of the larger issue of home prices going down in the United States of America. Now, overall, if we look at the country overall, the home prices haven't dropped that much. They're down about 5 or 6%. Nothing huge yet. But do keep in mind that some markets are seeing home prices down significantly more than that. Some markets are seeing home prices down 10, 15, even 20%. And if you remember, during the 2008 financial crisis, the crisis really started when home prices started to go down. Because as home prices started to go down, people began to be underwater on their mortgages and they just stopped paying their mortgages. And this led to a huge amount of defaults in the mortgage industry. Now, I do want to be very clear that as of today, the mortgage default rate is still at one of the lowest in history. People got extremely low interest rates. People are having no problem paying their mortgages at the current time. So we are not in any sort of residential crisis yet. But if home prices continue to fall, we could see a crisis later on in the future. So this is something to watch, but it's not necessarily something to be overly concerned about at the current time. However, that said, even as the number of people who buy new homes starts to go down, This ultimately causes issues with certain retailers, especially retailers who deal in furniture as well as home improvement. And Home Depot reported earnings this morning. Analysts were expecting a horrible quarter, and Home Depot managed to beat the horrible earnings estimates, but that doesn't mean their earnings were good. Home Depot may have topped earnings expectations on Tuesday, but they posted a 2% year-over-year sales decline as customers remained wary of big purchases and major projects. Home Depot still expects sales and comparable sales to decline between 2% and 5% compared with a year ago period over the next quarter. The company has seen continued caution on the part of consumers when it comes to larger ticket, more discretionary spending, and consumers are deferring bigger purchases because of higher interest rates. You can see on this chart how Home Depot's net sales have declined in Q2, and this is the third straight quarter of falling comparable US sales for Home Depot. Major purchases typically have to be financed either through a HELOC, a home equity line of credit, or a credit card. And as interest rates go up, this is causing people to hold off on those big major purchases. Now, this is not good news for Home Depot, obviously, but what does this mean for the overall consumer spending? Are consumers necessarily cutting back on spending across the board, or is this just major purchases? Well, the one good news that we got today is that retail sales increased 0.7% in July, which was better than expected as consumer spending holds up. Now, this was pretty much the only good news we got today, and it was also the saving grace for the stock market. Had this news not come out, we may have seen an even larger sell-off in the stock market on Tuesday. And it just goes to show that, yes, consumers do continue to spend, but they're not spending on things that require financing. They're not spending on cars. They're not spending on home improvement. They're not spending on new housing. They're not spending on things that require financing, but they are spending the cash that they're making on the products that they need. They're just maybe not spending so much on discretionary purchases. July's retail numbers were boosted by a 1.9% jump in spending at online retailers. And this might help online retailers such as Amazon, making Amazon might be a good winner from this. But a separate report showed that import prices moved 0.4% higher in July. And virtually the entire increase was driven by fuel prices. That means that as import costs go up, the cost of goods go up, which eventually means the cost of consumer goods goes up. And what all that translates to is just more inflation in the future. Unfortunately, a separate report showed that the Empire State Manufacturing Survey slumped 20 points in August to a reading of negative 19. This means that manufacturing here in the United States has slowed down considerably, and that is not going to be good news for the economy, especially when it comes to our exports. It means the demand for goods has gone down significantly, and this just added to more fears of an upcoming recession. To make matters worse, the stock market accelerated its sell-off shortly after the open after Fitch warned that it may be forced to downgrade dozens of banks, including JP Morgan Chase. As you might recall, last week, Moody's downgraded 10 small and mid-sized banks and warned that cuts could come for another 17 lenders, including larger institutions like Truist and US Bank. Also, earlier this month, Fitch downgraded the U.S. long-term credit rating. You can see here Fitch's ratings of U.S. banks as they currently stand. No bank has the highest AAA rating. They lost those during the 2008 financial crisis. The highest rating banks now have is one notch below AAA, which is AA minus. And there's fears that those banks could be downgraded to A plus, which would have a significant impact on the bond market and the stock market. Understandably, bank stocks sold off on this news. Now, the reason this would cause bank stocks to sell off is because as the credit ratings of the banks go down, this causes the interest costs for the banks to go up. So if the banks want to borrow money, if they want to issue bonds, they have to pay a higher interest rate in order to borrow money. And what this essentially causes is it causes their bonds to sell off, which is not good. It causes a lot of losses in the bond market, but also it means higher borrowing costs for banks, which in turn means reduced profits. And if a bank has lower profits, well, that's not good for their stock, and that causes their stock to go down. But the bigger fear here isn't just the warning of downgrades, it's that we now have both Moody's and Fitch warning of more bank downgrades coming. And right now, stocks sold off on the warning of a downgrade. What's going to happen when that downgrade actually occurs? We could see some significant selling in the bank sector. Now, I told you guys last week that I sold out of my bank stocks after Moody downgraded those 10 banks and warned that they were going to downgrade more banks. My fear last week was that more bank downgrades were coming and that bank stocks would fall even further. So far, I've been proven absolutely right on that, and I will not be buying any bank stocks until we get through all these downgrades, which probably won't happen until after both Moody's and Fitch make their decisions. Now, there might be an opportunity here to short bank stocks, maybe even with some put options, given the short-term duration of this, but do keep in mind it can take up to 3 months for downgrades to actually occur. So if you do decide to do any sort of bearish position, just make sure you can wait up to 3 months for a action to actually be taken by these credit rating agencies. What that means is I wouldn't do any short-term put options. I would be looking at more some longer-term put options. Probably January 2024 is kind of that sweet spot date where you have enough time for the bank stocks to actually go down without losing so much money to theta decay. So I think January 2024 put options on banks would make the most sense. Now, I do want to be very clear here. I'm not a financial advisor. Nothing I talk about is a recommendation to go buy, sell, or hold any asset. These are just my opinions. I may be wrong. I may be crazy. Please go do your own research before investing in anything. Now, if you thought the downgrade warning from Fitch was bad enough to send bank stocks tumbling, it got even worse after Fed President Kashkari advocated significantly further capital regulation. Basically, what this means is that the Fed wants to increase regulation on the regional banks. And what that does is it forces these regional banks to hold more cash on hand. Now, the more cash they have on hand, the less cash they can go invest. And if they're not able to invest as much cash, then they can't make as much money. And if they don't make as much money, this causes profits to go down. And as profits go down, you guessed it, the stock goes down. So that's why bank stocks sold off even more after the Fed came out and said this. So it was just a horrible day for bank stocks. We saw the Dow being the largest loser of the day comparatively. The S&P also took a major hit. Of course, the Nasdaq and Russell also took hits, but it was mainly concentrated in the Dow and the S&P. And this looks like it's going to get worse before it gets better. Technically, the stock market looks like it's going to continue to fall. The stock market technically does not appear ready to bottom out or rebound. It looks like we're going to continue to fall. It looks like we're going to continue to see that August and September sell-off like we historically do. Now, talking about all these earnings, let's talk about some of the remaining earnings that are coming up later on this week. Earnings season officially ends this week. Now, just because earnings season ends doesn't mean that all earnings are going to end. We still have earnings that are going to come out. Most notably, NVIDIA reports earnings next week. But it does mean that the official earnings season ends, which means the number of companies reporting earnings is going to drop significantly after this. Still, let's talk about some of the companies reporting later on. We've got Target Wednesday before the open. We got Cisco Wednesday after the close and Walmart Thursday before the open. Now, what we learned from these earnings last quarter is that Target and Walmart, even though they appear to be very similar companies, actually had very different earnings results. And the main reason for that is as consumer spending has continued to increase, it actually has not been on discretionary items. It's been on food and groceries and needs. What the result of this is, Target is more focused on discretionary items and less focused on grocery, while Walmart is more focused on grocery and less focused on discretionary items. What that meant for earnings is that Target ended up having bad earnings, while Walmart ended up having good earnings. So we might end up seeing the same thing again this quarter, as things really for the consumer have gotten worse, not better, which means there's a chance for Target to miss earnings and for Walmart to beat earnings. So just keep that in mind, that these are not the same company and we could get very different earnings results, just like we did last quarter. Now, speaking of the consumer continuing to struggle, I know a lot of my viewers are also struggling. I know this. I've seen your messages. I've talked to some of you. I have met with some of you. And you've told me that you're struggling. You told me that things are hard, that your income's not going up. You've told me that your expenses keep going up. Your food keeps going up. Your gas keeps going up. Your rent keeps going up. And things are getting really, really hard right now. And some of you that I've spoken to have even been laid off from your jobs. I want to let you know that there's hope. I created a video for you last night. It's not my typical video that I normally do on this channel. It's not a market update video. It's a special video just for you to help you get through these tough times and to give you some hope for the future. If you missed yesterday's video, I strongly encourage you to go watch it right here. It's titled "Some Money Mistakes That Might Be Keeping You Poor." Some money habits that you're doing that might be keeping you poor. It has some incredible advice in there, as well as a lot of hope for the future. If you're struggling at all with your financial situation right now, I strongly encourage you to go watch that video, be encouraged, and come back here ready to make some money.